Stocks trade in a narrow band with the mid-caps actually underperforming. Advances and declining stocks balance each other. Realty and financials eke out some gains, and led by power and healthcare, which actually trades soft.
Dmart owner Avenue Supermarts reports slower revenue growth and a dip in margins. The retailer cites impact of online grocery sales on business, leading analysts to trim their growth forecasts. The stock slips.
Auto sales have got off to a strong start. Auto dealers tell CNBC-TV18 that attractive offers on personal vehicles and two-wheelers are likely to lead to a good season that would help correct record-high inventories, they add.
Industry veterans see Noel Tata bringing stability to the Tata Group with a calibrated approach to growth. A sharpening of focus on consumer-facing businesses is also likely, but the new chair of Tata Trust isn't likely to do anything in a rush.
India's industrial output in August contracted by 0.1%, while many segments like power, mining and infra, as well as capital goods, showed contraction or weak growth. Some economists see heavy rains as the reason, but some say seen along with weak GST collections in September, August IIP raises fears of GDP downgrades for the second quarter.
Hello and welcome to Halftime Report. I'm Ipca Labs and with me is Mangalam Malu. Well, it's turning out to be a session where we are seeing some amount of an uptake which has come in for the markets. Overall, it's mixed, you'd have to say, at this point in time. So we have the Nifty, which is above 25,100. The mid-cap index, which is just about consolidating, and the Bank Nifty, which has had a couple of rough sessions in the past week odd, is now seeing some amount of an uptake. So the Bank Nifty up around 1% odd. So overall, the texture of the market looks okay, considering that the advance decline ratio is currently on the advancing side. We do have a lot of results to watch out for. Obviously, the big boy Reliance Industries, besides that, HCL Tech, as well as a couple of other ones such as Angel One. We do have the WPI inflation data, which is flashing on your screen. So 1.84% is where the WPI data has come in. So that's an uptick versus the 1.31% on a month-on-month basis. But remember that the WPI data was expected to be around 2% for the month, and it's come in just about below 2% in terms of levels. So that's the preliminary data that we have. We have primary articles inflation, which is coming at 6.5%. So there's an uptick which has taken place on a month-on-month basis. Any more details, Mangla?
But we do have a bunch of others as well. So the commodity index is up 0.1% on the month. We do have some data coming in from, fuel and power as well. Fuel and power, as I see, is actually down by 4.05%, and this was lower, a lot less lower in August, 0.67%. Manufactured products have actually seen an inflation of 1%. This number was 1.22% in August. And you have all commodities index, which were up just 0.1% as well. Food, 1.1%. Primary articles, interesting out there as well, they are up 0.4% on the month. So month on month, there has been a bit of an inflation, and primary articles is the one which is actually doing a lot more than all the other parts of all the other components of the WPI this time around. And potatoes, 78%.
Yes, absolutely. And the food inflation, which is coming at almost 10%. So it's coming at around 9.45%, for 7% to be precise. So that's an uptick that we've seen on a month-on-month basis. Just want to point out that we'll also wait by for the core WPI, which is possibly expected to ease. So let's see if that takes place on a month-on-month basis. And overall, we have even a couple of other data points, such as the fuel, which is in deflation mode of around 4%. We do have Madan Sabnavis, Chief Economist, Bank of Baroda, joining in with his quick view on the WPI data. Mr. Sabnavis, thanks very much for joining in. What is your reading of WPI, which is a sub 2% figure?
In fact, we were looking at a number of 2.2%, so I think 1.8 definitely sounds better. So I would tend to think that we have to be a bit watchful of this number, because I do see an upward tendency in the coming months, primarily on account of the fuel prices, something which we haven't really seen. I think from what you have mentioned, there's been a negative growth in prices for the fuel component. That is something which should be moving upwards, given the fact that the trend has been trending upwards. And second, I look at even core inflation. I think core inflation is something where we are seeing a number number of manufacturers stating that they have been holding on to their input costs for a long time, and now that they are in the process of increasing their final prices, there could be a gentle push in the upward direction, even for manufactured products. In terms of food inflation, I think there should be some bit of moderation which we can expect, primarily on account of the expected good Kharif crop. Though I think the only apprehension is that the monsoon is still not fully withdrawn from the country, and therefore we have seen in states like Maharashtra, there is definitely a case of vegetable prices being high, and that is something which will probably remain for some more time. So we have to be watchful of these numbers, but on the whole, I think 1.8 is a good number, but we could be expecting the number to move upwards in the coming months.
Okay.
You can expect the rate to move upwards in the coming months. The question is then what happens to, what the RBI has on their minds, because this time around they did change their stance to accommodative. What's the sense that, neutral rather, from withdrawal of accommodation? What's your sense in light of this higher inflation, would they do?
See, actually, if you're looking at the RBI, I think they're targeting the CPI inflation number. So I don't think the WPI will play a major role in terms of any decision taken by the RBI, even though they do keep this at the back of their minds, because what happens with WPI finally also gets reflected in CPI. But in terms of the RBI's policy, I think one has to be a bit more patient from the point of view of industry and wait till February. The reason being that the RBI's projection of inflation for the third quarter is 4.8%, which is closer to 5%. So I think while the stance has been changed to ready the market for a possible rate cut in future, I think it's still a way off until this CPI inflation number comes at more hospitable levels. Right now, we're looking at a number of close to 5%, both for September as well as October.
Okay, all right. Well, we will have the CPI data this evening. So what is your expectation, Mr. Sabnavis? Any takeaways from the WPI, which you can probably extrapolate onto the CPI?
See, it's good. We have a projection of 5.1% for inflation for September, and I think a large part of that is going to be contributed by the food basket. What we have seen is that the core inflation in part of the CPI has also been moving gently upwards, 3.3, 3.4%. But I don't see that being the major issue in this particular month. It's going to be more on the food side, more in the horticulture products, as well as pulses, which have been the problem areas even in the earlier months.
Okay. So what would your entire reading be, based on what you are seeing on a trajectory for WPI? Because at this point in time, we are also dealing with maybe fluctuating crude prices with what's taking place in the Middle East. In that sense, what would your average be in terms of the WPI data based on the commodity cycle?
So in terms of the next few months, I would look at an average of 2 to 2.5%, because if you looked at global commodity prices, not just food prices, but also of metals, they have also started moving upwards. And ever since we've heard of this stimulus which is being provided by China, I think there's been a tendency for commodity prices to increase further. And this is something which will continue in the coming months, given the fact that China is the largest consumer of most of the metal products. So this said, I think this is going to feed into our manufactured inflation indices also. So there will be a tendency for core inflation to also keep moving upwards. Nothing really something which is going to startle us, but on the whole, I think we're looking at this 2.5% in the next 6 months.
When do you expect the first cut from the RBI?
Yeah.
When do you expect the first cut from the RBI?
But from the RBI, I think it's February would be the first, would be the earliest. Definitely not in December. And I think even in February, it would be a call taken after they do a review of how inflation has panned out. Now, again, if I go back to their own forecast, they're expecting inflation to come down in the fourth quarter. So one would tend to believe that by December, you'll have a full idea about how the Kharif crop has turned out to be, as well as how the prices have moved. And in case it tends to be moving towards satisfactory levels, I think we could have a cut in the month of February. I think there's a divided view here. There are some economists whom I've been talking to who do believe that in December there could be a cut. But I think with a number of 4.8%, it would be a bit hard for the MPC to actually agree to the fact that inflation has come down on a durable basis.
Okay. So you're expecting the first cut from the RBI to be in probably February. The quantum and what would the timeline of future cuts be post that?
See, I think the quantum would probably be 25 basis points to begin with, and depending upon how inflation continues, because that's going to be dependent a lot on the geopolitical situation as well as the Rabi crop, because once we go in towards February, it will be a case of the Rabi crop and their prospects. But assuming everything is normal and we are in this region of 4.5% of CPI inflation, we could be looking at around 25 to 50 basis points cut in this particular cycle. And this would be probably the average of what CPI inflation, the repo rate has been in the last 10, 12 years. So 6% appears to be a fair value for the repo rate, with an inflation in the region of around 4.5% on an average basis.
Okay, all right, Mr. Sabnavis, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that is the September WPI data, which is coming at around 1.84%. Bank of Baroda expects the first cut from the Reserve Bank of India to probably come in Feb, and that too to the tune of around 25 basis points. We'll take a short break. Up next, we'll focus on stocks that are moving in trade on the back of news. Stay tuned.
Welcome back. You're watching us here on Halftime Report. One of the stocks on the way down today has to be Dmart. Avenue Supermarts is what we're talking about, and that's largely because of the weakness in their second quarter earnings. Over the last many quarters, there has been weakness in their margins, in particular related to the product mix, etc. At the same time, weakness in consumer sentiment. But this time around, brokerages have also turned bearish on the stock because of a very specific reason. That being the management themselves calling out, competition impact coming in from some of the online players. So if you just take a look at the numbers, it seems like the structural decline in the margins has begun for Dmart. The management commentary does say that there has been impact in the metro stores on account of online retail. So all your Blinkits and quick commerce related issues have actually impacted growth in Dmart itself. On the revenue front, while there was a growth of 14%, the margins have actually taken a bit of a beating. 8.8% is what the EBITDA grew at, margins at 7.6%. Net profit grew by just under 6%. If you look at the same, the gross margins as well, close to around 14.9%. This compares with 15.6% the same time in the previous quarter itself. There has been a decline. And at the same time, if you look at the same-store sales growth too, the same-store sales growth has come in at around 5.1%. This compares with 9.1%. The company's been ramping up their Dmart Ready business. So the implied business on Dmart Ready has actually shown a revenue growth of 24%, but the EBITDA has turned into a loss because they are in an expansion phase out there. If you look at what the brokerages are saying, Morgan Stanley, they've downgraded the stock to underweight, and the target price has been cut to 3,700 rupees because they're saying that the management commentary this time around puts a doubt on that 20% top line growth algorithm that they had for this business. This could lead to further derating. Remember, this is not a particularly cheap stock. You have CLSA as well, which has cut FY25 to FY27 estimates by about 13 to 15%. JP Morgan has lowered their same-store sales growth and revenue forecast by about 4 to 6% over the next couple of years, and as a result of which, the EBITDA and net profit forecasts have been slashed by about 8 to 10% as well. Goldman Sachs says that while competition from Q-commerce had impacted this quarter, this Q-commerce expansion is likely to continue, impacting the company going forward as well. And another factor that may not be doing too well for Dmart, which has already seen a bit of a correction of over 20% from its highs, is the shareholding pattern. If you look at it, the promoters own about 75% of the stake in the company, and then you have institutions which hold stake in the company as well, which would be to the tune of close to around 7%. That's the mutual funds. And then you have some of the foreign portfolio investors as well, holding about 9% in the company. So you have all in all 75% owned by the promoter, 16% owned by institutions, leaving very little free float. So there could be a further impact on the stock price on account of that as well. We'll keep an eye out on how this pans out. But, this is definitely not a one-quarter phenomenon. Seems like recovery might take about 3 to 5 quarters, whichever way you cut it.
Okay, all right. So that's an Avenue Supermarts. That stock is in focus. But I'm looking at Motilal, which has spoken on Ipca Labs. They've upgraded the stock to buy with a target price of 1950. They say it's at an inflection point. Ipca is well poised to deliver strong earnings growth over FY24 to FY27. It is broad-based growth in volume and pricing, according to them. And Ipca has been able to outperform the industry significantly in domestic formulations, making efforts to augment exports prospects via new launches as well. They are working on driving synergies from the Unichem acquisition and are geared up to revive the US business via improving US FTA compliance, new launches, as well as synergies. So as you can see, the stock is holding up with a gain of around 1.7%. Motilal has upgraded the stock. We'll take a short break, but get you more stocks in focus on the other side. Stay tuned.
Welcome back. You're watching us here on Halftime Report. Look at the market from an F&O standpoint right now. The Nifty is doing well, almost 170 points on that index at the high point of trade. We're doing well for the mid-cap index as well, rather Nifty Bank as well. The mid-cap index is the one which is actually underperforming just at the flat line too. For the Nifty, there could be technical reasons for this outperformance as well. We've crossed the 50-day moving average this morning itself. The question is whether we sustain above that or not, because over the last few trading sessions, above 50-day moving average, we've seen a bit of sell-off. If that continues, if we continue to do well above this 50-day moving average, maybe a dash towards the 20-day moving average cannot be ruled out. It all depends on what the Nifty Bank does. The Nifty Bank is doing better today, and it's crossed the 50-day moving average, about 700 points away from its 20-day moving average as well. And then you have the rupee at record low as compared to the dollar at 84.2. The good part is that bulls are finding some support at lower levels. 25,000 put on the Nifty is very active. Premium of 50 rupees telling you that 24,950 thereabouts could be the first support. On the way up, a very near term, 25,100 put 2 is fairly active for a premium of 100 rupees. So between 24,950 to 25,000 could be some bit of a support is what the expectation is. On the way up, however, 25,100 call writers are active, telling you around 25,250 could be some bit of congestion and supply coming in for the frontline index. In terms of stocks, I'm watching out for Nalco, because with the kind of up move that we've seen, there has been an open interest jump as well. The stock was already on the verge of crossing that threshold of entering F&O ban. Now it's reached 102% as of right now, and maybe the stock may enter F&O ban in today's trading session.
Go ahead.
All right, on that note, what we do is take a short break, come back, and on the other side, we'll have, the management of Morepen Labs saying that the company may hive off medical devices business. That's the word going around. Let's see whether the management confirms that or not.
Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, the Bank Nifty is up around 1%, so doing well. We have the advanced decline ratio also, which is steady as of now. So no worsening which has taken place there. But nonetheless, let's talk about Morepen Labs. That stock is in focus on the back of reports that the company is planning to hive off its medical device business into a separate unlisted subsidiary, possibly in the next 12 to 24 months. To discuss this, we have with us Sushil Suri, who's the chairman and MD at Morepen Labs. Remember, that stock has rallied quite significantly. It's up around, I think, around 180 odd percent from its 52-week low of around 31 odd rupees. So it's been a great movement for that particular stock. But Mr. Suri, thanks very much for joining in. If you could just start by clarifying on this business standard report, which indicates that you're looking to hive off your medical devices business, and eventually you're probably looking to even monetize it or unlock value.
Yeah, basically the medical devices business had been growing rapidly, and we are seeing that the opportunities are increasing as we speak. So we feel that, okay, this business needs a little more focus, and more importantly, it needs growth. So to do that, it needs a separate style of management, it needs separate financing activities, and more importantly, it needs a separate sales team. So we have already taken an approval from the shareholders to hive it off into a separate subsidiary, 100% subsidiary. Of course, we are looking at the logistics and regulatory matters. But question is of unlocking. So unlocking may happen in sort of an IPO. It may happen in sort of a bringing a PE player. So there are various options which we are exploring. And of course, we have not closed on anything. But as I think you have seen that the value and the valuations of the medical devices business are much more than a typical traditional API business, what we have been doing. So we have been advised that it is better to keep that into a separate subsidiary. And as we go forward, we are seeing the growth potential exponential. And sorry, the global markets of medical devices have been growing 10-11% as against the industry average 5-6%.
Right.
But India, the medical devices are growing 30%. So we see that a huge potential is around, and we would like to encash it as fast as possible.
All right. What do you mean when you are looking to, encash the value out here? Because are you looking at listing it separately? Are you looking at getting in a strategic investor? Are you looking at getting a financial investor? Because this growth opportunity that is there would also mean that there is a fair amount of investment that you would have to do. You recently raised funds via QIP, but are you looking to raise some more in this specialized subsidiary?
Thankfully, this particular division, medical devices, is a cash cow and it generates sufficient cash. We may not need much cash flows. But if we go to set up global capacities, the global capacities have to be formulated according to the, I would say, global requirements. So that's where we would need extra cash flows. That is where the additional capex has to be done for this division. And more important is that once we go for increase in cash flows, so the overall, I'm sorry again. So the overall growth potential of the business increases substantially. So we are open to go to market with PE players or even with an IPO, but nothing is finalized as on today. But the value of the medical device business itself is more than the value of the company. As we have been advised time and again that why everything is sitting in one company. We have API, OTC, formulation, medical devices. So as Morepen, we are a 40-year-old company and we have multiple verticals. So all verticals are growing. So we want to focus on each vertical separately. That's what the whole plan is.
Okay. How much are you expecting, your medical devices business to grow in FY25, and what is a sustainable run rate for you?
Look, the industry per se is growing potentially between the government of India has put up a target of 28%. And fortunately for us, we are almost the same number. We have been growing at 27-28% CAGR. And our target is that, okay, we should double every 3 years. So we are expecting little more than 500 this year. And the target is to double up in 3 years' time to do 1,000 crores in the next three financial years after this. And going forward, we want to put up heavy target because we have huge potential for the export. Going as is, where is basis where we are today, we expand the domestic market, we increase our distribution in South and East where we are little weak today. Weak means we are less than the North and West. Our 65% of revenues come from North and West. So we increase our revenues in the rest of the India, plus we increase our product basket, but that will make 1,000 crores. But important is after that, we want to go to exports. So in exports, India is becoming the market hub. I mean, everybody knows India is a manufacturing hub. Particularly in medical devices, once we start the export to US and European market, I don't think there is any limit. This 1,000 crore can go to 1,500 crore, it can go to 2,000 crores. So we are seeing huge potential.
So just to clarify, 500 crores is what you're aiming for in terms of revenue from the medical devices business in FY25. And you're expecting around a plus 25% CAGR in terms of the business going forward?
Yeah.
Okay.
Just between 500 to 550. And last year it was 440. So we're expecting a little more than 500. But yes, you can assume that.
Okay. Can you just give us a sense in terms of the glucometers? What kind of innovation are you looking at when it comes to your glucometers? In terms of growth, because now we are seeing this continuous glucose monitoring which is taking place, and that's probably becoming even more prevalent. Anything within your pipeline that you have in terms of more innovative products which you're bringing to the market, and at what pricing?
Basically, there are two types of innovations happening. One, of course, is the existing product. How do we because existing product people are using. There are 12 million users what we have, and there are other companies who have I think almost similar presence in the market. So we are as big as all of the rest of the players together. So in the same product, what we are planning and of course going to execute is a Bluetooth connectivity, so that people start collecting their data. India had not been very fancy about collecting data, and people were trying to keep it as simple as possible. And that was our plan of the strategy. That was part of the strategy, that we don't want to complicate the process. So what we have done now is that, okay, we have a base. Now from this base, the whole first step would be go for connectivity. And then, of course, coupled with the high-end AI applications, and we all know what AI can do. I don't want to get into that. So that is where the first step, so that we start getting the data of the customers and data of the patients. And diabetic being diabetic, and it's one of the second big killer in the country. So we want to do the device data part. Second, I think, is the continuous glucose monitoring. So that is where our main focus is. The company has been spending a lot of resources on doing a continuous glucose monitoring. So presently there is one product from Abbott which is extremely costly, which has, I would say, almost 10,000 rupees per month. So we want to bring the cost down to 1,000 rupees per month. So that is what we are working upon. And once we have the product in the market would be ready. As on today, obviously the market is also not ready. So those are the two major innovations of the glucometer which are happening.
All right, you've given us the guidance for the number of strips and glucometers that you intend to sell over the next few years. You're increasing your capacities out there as well. Mr. Suri, thank you so much for joining in. We'll talk to you another day post your results, perhaps to get a sense of your non-medical devices, the API business, etc. as well, the impact of China. But that conversation for another day. Thank you for joining us today. We take a short break, come back on the other side. We'll talk about Reliance Industries, the big boy reporting its numbers today. We'll get you more on what the street expectations are after this break. Welcome back. You're watching us here on Halftime Report. A bunch of stocks doing extremely well. Case in point, CDSL at the bottom of your screen, which is spiked to the high point of trade with a gain of almost 5.5%, even as we're seeing some weakness in the mid-cap end of things. Just watch out for Reliance. The big boy will be reporting its second quarter numbers today. And we are looking at Reliance from all, different angles. Let's talk about the retail space first. There is a sequential improvement which is expected in the consumer sentiment in the retail business this time around. Store footprint as well as format expansion will support the growth this time around. Revenue growth of 8% is what the street is expecting this time around, which would mean about $10 billion in terms of quarterly run rate. The EBITDA flat as compared to last year. Margins holding at around that 7% mark as well. Key to track this time would be how the festive season is and whether there would be any operating leverage play out as well, because of the new formats that are in focus. You have the Tira, the beauty vertical, you have U-Star, you have Swadesh, all of them which would be aiding growth. And there has been an aggressive footprint expansion by the beverage company Campa, which they acquired too. Reliance Retail currently has close to around 19,000 stores, so store expansion is something that we'll be tracking as well. Retail area of 81.3 million square feet as of the last quarter, and digital and new commerce accounting for nearly a fifth of their sales. How that business pans out, because especially as Dmart has called out an impact of quick commerce on overall retail, is that visible in Reliance Retail or not as well, is something that we will track.
Okay, all right, Manglam. Thanks very much for that. That's on the retail business. But Rima joins in with key expectations from Reliance Jio.
So expect a very strong quarter for Reliance Jio this time, because this is the quarter when the full impact of the tariff hike takes effect. So remember, Reliance Jio announced nearly a 20% tariff hike at the beginning of July. It was effective 3rd of July. So July, August, September will benefit from that, which is why we're expecting a 7% top line revenue growth quarter on quarter. On margins, we're expecting 100 basis points margin expansion to 53.6%, and this will drive a 12-13% sequential increase in the company's profitability. And because of this tariff hike, even the average revenue per user, which has been stagnant for the last, I think, close to about a year and a half, almost 2 years, at 181, 182 rupees, will suddenly see a jump of 6.5% to 193, 194. We don't see a complete pass-through of the tariff hike in one quarter, is because it takes, the impact of this whole 20% tariff hike plays out over the next 2 to 3 quarters. It depends on when your recharge cycle is. Some people may, there is some sort of SIM consolidation which takes place, which basically means that if you have 2 SIM cards, because of the higher cost of ownership, you may choose to give up 1 SIM. So which is why the ARPU increase is seen at 6.5%, but some subscriber loss is also possible. And according to the CNBC-TV18 poll, it could come down by 1.5%. But all in all, as I said, expect a very strong quarter by Reliance Jio, driven by the tariff hike that took place effective 3rd of July, which was about 20%, and this will drive Jio's performance in the current quarter. Back to you.
Okay, all right, Reema. Thanks very much for that. So that's on Reliance Industries. We'll take a short break. On the other side, a commodity corner, Manisha Gupta will be in conversation with Edgar Baster, who's the global COO of BHP. Stay tuned. Welcome back. Well, Manisha Gupta now joins in. She's tracking the commodity space for us. Manisha, over to you.
In terms of geopolitics, you're right. The world is a little bit more volatile than what we've seen in the past. But we believe that global growth will continue to persist at about 3% for 2024 and 2025. Now, for ourselves, we actually believe that India, in particular, that's looking at GDP growth of about 7%, and China at about 5%, that will contribute 50% of the global growth overall. And so there's a lot of opportunity for commodities that will be essential for the future, such as potash, copper, and the steelmaking materials that you referenced at the start.
A lot of people seem to be believing that we are just getting into a structural bull run in case of commodities. Would you believe that?
Look, I think commodities are volatile depending on where the development cycle are in each one of those areas. We believe copper in particular is potentially at the start of one of those bull runs. And the reason being is that we're seeing a lot of growth, both in traditional demand, but also driven by the energy transition and also technology coming forward as well. So we expect that copper will grow by 70% relative to this year out to 2050.
All right. Well, I have read some reports and BHP has been quite bullish about copper. So for the near term, it clearly is about the Chinese demand, which is not so great. And then the world is also looking at some slowdown in Europe. The bright spot clearly has been India to some sense. So for the near term, how would you look at demand? And slightly longer term as well, where do you see the maximum demand coming from?
Well, first up, we are so excited about India. And how can you not be excited about India? And we are thrilled to be part of bringing forward the sustainable development in this country. And that's really been a key message for us throughout the week. Now, in terms of demand, as I mentioned earlier, copper, I think, is going to be an exciting commodity to be a part of. And you're right, we have seen a bit of decline out of China in the last year, but that's being offset in other areas as we see increased pull for new technologies associated with renewables, and also with data center usage basically starting to pick up. That's going to be a big growth area for us as well.
As we understand in sense of copper that the mines are far and few, the new ones that is, the new projects that is, and how is BHP approaching the supply part of it for the longer term with the kind of supply needed to fulfill that demand? How are you looking at the numbers stacking up?
Well, that's tremendously well said. So demand looks very robust moving forward. Supply is going to be a challenge for a number of reasons. One, copper is becoming more and more difficult to find. And in the jurisdictions where you actually find copper, the ability to bring that on at pace is taking longer. And so what that means is if you have copper as part of your portfolio, you're in a very good spot. And so for BHP, we have the world's largest global copper endowment at over 44 billion tons of copper ore greater than 0.5% copper. And so really our opportunity is how do we actually work with partners and Indian partners to actually bring forward that future opportunity.
Just coming back to supplies yet again, and there was this Anglo-American buying bid that you did work with, hasn't worked. Is the conversation still on with them?
We've moved on. Okay. So obviously we were a bit disappointed in terms of where that landed. Nonetheless, we thought there was a good opportunity there. Unfortunately, it didn't progress, and we're back to plan A, which has always been about that massive endowment that I just talked about. and really excited to bring that forward to the market over the next couple of years.
There also has been a recent JV with Botswana. How is that working out for you?
That's progressing reasonably well, so watch the space.
All right. Also, if you look at the prices and volatility, that has been quite immense in the recent few times. We've seen an all-time high, and the markets did put out an expectation that we could perhaps be going to 12,000, 15,000 next year as well. Would you believe in those forecasts, and what's your own sense?
I've given up trying to predict where commodity prices are going to land in the longer term. What I can say is we have a very robust process of actually taking a look at what we think potential demand is and where that supply will sit. And longer term, we're very bullish as an organization about how that will unfold. But I guess we'll see how that progresses over the next couple of years.
So even if I can't push you to tell me your price, is there a range that you're working with for, let's say, the next 12 months?
We don't get into disclosing price speculation. Obviously, that's a part of what differentiates us and our strategy moving forward. But it'd be fair to say that copper will be a central platform for us as an organization.
All right. We've moved between deficits and surpluses when it comes for copper. How are you looking at the next 12 months in that sense?
So in the next 12 months, we actually expect copper cathode will see a slight surplus, and that will probably persist into 25 as well. Copper concentrate, though, on the other hand, we expect to see quite a shortage, and that's actually reflected in the treatment charges and refining charges that we're actually seeing across the globe, with those actually being quite close to zero as those smelters and refineries continue to try and operate.
Okay, so that's the word coming in on the commodity space. Well, for the markets, it's a mixed day. Like we mentioned, the mid-caps are just about consolidating. Nifty is up around 0.6%. It's a wrap on Halftime Report. Business Lunch up next.